last two. So I'm honored to invite Governor Lesetja Kganyago of the South African Reserve Bank to join us for opening remarks. And Lesetja, the floor is yours, and I wish everyone a fruitful and enjoyable annual conference. Thank you.
Chairman of the International Association of Insurance Supervisors, Shigeru Arizumi, the Secretary General of the International Association of Insurance Supervisors, Jonathan Dixon, members of the Executive Committee of the International Association of Insurance Supervisors, supervisors, CEOs, chairs of supervisory committees, ladies and gentlemen, welcome to South Africa. Our program director welcomed you in isiXhosa, and she said in her interpretation, she has just said welcome to South Africa. What she actually said is welcome to the Cape. That is actually what she said. Let me start by thanking Jonathan Dixon for his years of service as Secretary General of the IAIS. I am not sure if South Africa was better off having him working in Basel rather than Pretoria, but we certainly feel proud of his work, and I am glad he could bring you all to South Africa for this conference. Judging from the history of previous conferences, I know that the IAIS tends to find some exotic island to go and hold the conference, but given the numbers of you who had decided to pitch here, Robben Island was not big enough to accommodate all of you. Well, now to the business at hand. You know, my trade is actually monetary policy. All the others are just an addition to what I do. And so one of the workhorses we use in monetary policy is a model that we use for interest rates. It's called the quarterly projection model. And that model is a gap model. It's a 4-gap model, and it works like what is the gap between inflation and its target? How far is inflation from its target? It works on a gap of how far economic growth is from its potential. It works on the basis of how far is the exchange rate from its equilibrium level, and it identifies the gaps. And lastly, the most important gap is the gap between the interest rates and its natural level of interest. And so we talk about gaps. Every 6 to 8 weeks, we will come and talk about the gaps and adjust one gap that we control, which is that of interest rates. But coming into this meeting, I had to try and understand what the gaps are in the insurance industry. Well, the insurance industry accounts for 7% of the global economic activity. Historically, the role of insurance has been about protecting basic life and business needs, to protect our shelter and our business premises, to protect our individual health, the health of our businesses, and to protect our loved ones in the event that we die. In this way, insurance makes society more resilient. Indeed, Regulators and supervisors sleep better at night knowing that there is this line of defense. But we only really put that theory to the test when there is a crisis. For better or worse, crises have not been in short supply lately. So we have been able to test the strength of our insurance sector. I would like to start today by looking at some of the lessons from recent crises. The first crisis, of course, was one we all experienced, COVID. A global pandemic was certain to have a large impact on health insurance claims. With the higher mortality rates, life insurance claims increased, but none of us expected the whole world to stop at the same time. Overnight, we had to consider the implications of insurance for cargo at sea and the practicalities of business interruption insurance as lockdowns stretched for periods beyond 1 week. COVID was a particular challenge for life insurers for the obvious reason that it triggered an abrupt increase in mortality. What we saw in South Africa was resilience from firms that have accumulated large capital buffers over many years and which expanded their reserves as they saw the scale of the shock. It was a good example of why you want to have a fortress balance sheet, even if you think you have fine-tuned estimates of your obligations and you feel safe. There will always be shocks you don't see coming, and then you will need somewhere to hide. The second example of crisis had to do with heavy floods. Of course, different regions have experienced these at the same time, most recently in Valencia, in Spain. I'll stick to the region I know best. In April 2022, the province of KwaZulu-Natal, on South Africa's Indian Ocean sea coast, was hit by heavy floods. Whereas COVID was a particular challenge for life insurers, this was a challenge for the non-life sector. But once again, we saw resilience. In this case, a major reason for that was reinsurance. The South African insurers had bought their own protection from major global firms, so in the best traditions of insurance, the risk burden was shared, and that made it more tolerable. The third crisis is an example of country-specific risk. The electricity shortages in South Africa reached near unsustainable levels during 2023. It had eased more recently. Unfortunately, the insurance angle on this is less of a success story and more of a cautionary tale. This is because as insurers considered the scale of business disruption and as they contemplated the possibility of a full grid collapse, it became clear that this was unmitigated risk. It also meant that there was no reinsurance coverage. You won't be surprised that specific policy wording language had to be modified, and soon insurers started sending notices saying that existing policies did not cover electricity failures and couldn't compensate for grid collapse. In other words, there was a protection gap opening up where a risk was becoming uninsurable. This gave us a taste of a huge new problem where something we previously didn't have to worry about developed into a big risk and simultaneously become uninsurable. A problem we may all facing as climate-related risks materialize. Insurance protection gaps remain a source of concern for policymakers and insurance supervisors globally. The progress made in shrinking these gaps has been muted, with too little focus on the vulnerable in society. This is a problem that the IAIS can address in its work program. South Africa, in assuming the G20 presidency, can also assist in driving the financial inclusion narrative, focusing on insurance protection gaps. Now let me turn to policy. We have huge challenges to face, and one of the most important ways our societies adapt is by adaptation policy. Sometimes in small steps, sometimes in big steps, learning lessons and applying expertise to do things better. One such example of a big policy leap in insurance is the emergence of digitization and the reliance that organizations have placed on these technologies in their day-to-day operations. Organizations are progressively adopting and implementing these digital processes and solutions, converting and re-engineering their services and products to amplify their efficiency and productivity in an ever-competitive environment. Some key digitization risks and areas include data breaches, cyber attacks, artificial intelligence, machine learning, Internet of Things, digital business interruption, cloud computing, and blockchain. The insurance sector has also focused on creating solutions to cater for cybersecurity cybersecurity threats as a result of digitization, and have developed products such as specialized cyber insurance policies, digital asset insurance, business interruption insurance, and parametric insurance. I am happy to say the International Association of Insurance Supervisors has also been taking some big leaps lately, leaps that have changed the way insurance supervision works. One big move is the adoption of the holistic framework. This takes the focus of a small number of globally systemic institutions and shifts it to the system instead. Basically, we are now seeing the forest rather than just seeing the bigger trees. And through the global monitoring exercise, we try to see the forest clearly. Another leap is the finalization of the insurance capital standard. This has been a long and difficult process. I know whenever financial institutions are prompted by regulators to hold more capital, there is always pushback, always reasons why these specific institutions aren't risky and don't need capital. But as I said at the start, when the crises come, as they inevitably do, the fortress balance sheets are the ultimate refuge, the safety that keeps firms solvent and that helps society cope. Ladies and gentlemen, to conclude, it is hard to look around the world now and feel much comfort that risks are under control. There is a lot to worry about. I don't know what historians will say about the 2020s and the 2030s, but it may not be a happy story. Now, if those historians turn their attention to the insurance regulators, and as we know, some historians can be very thorough, so it is not impossible. What will they find? What will they find we were doing early in the 2020s? They will see we were focused on resilience. They will see we took a systemic perspective, doing our best to understand the risks, not just within firms, but for the system as a whole. They will see we were building capital buffers. What will they make of those efforts, of our efforts? Inevitably, they will judge them by their results, because history is usually a process of judging inputs by outcomes. But with a little luck, I hope our efforts will strike them as enlightened and prudent and equal to the challenges coming our way. And if luck doesn't come our way, I urge you as supervisors to make your own luck. Thank you.
Slightly vertically challenged, so this will happen a bit. Thank you so much, Governor. Thank you for those instructive remarks and for giving us all a lot to think about as we go into our panel discussions and as we go into the roundtables later this afternoon. It's now time for the EXCO Town Hall session, and for that I would like to invite the chairperson of the IAIS EXCO, Mr. Shigeru Arizumi, to come forward, and after that we will go into the panel discussion. Please, let's welcome him warmly.